Hey guys, so I'm gonna be making my first video about the economy that I have made in the past 2 months, I guess. The first thing I want to start off with is valuations. So if we go to my Twitter, I actually reposted this. Credit goes to Henrik Serberg, which pointed out the valuations in the stock market. So if you think this party will go on forever, I'm sorry, my friend, you're very deluded. Current valuations are as extreme as in 1929. PE ratio stands for price to earnings ratios. Back in 1929 at the peak, it was 32 and a half. At the dot-com bubble peak, it was 30. In 2007, it was 17, and today it's 30. Market cap, the stock market's market cap to GDP ratio was 87% in 1929, 137% in 2000, 105% in 2007, and 208% today. All right. So you always hear this argument, hey, things are different now compared to 1929. Right, things were different in 1929 to 2000, and 2007 was also nothing like 1929. But you know what never changes? Human greed. If you borrow money to speculate in risk assets, it doesn't matter if the year is 1929 or if it's 2024. If a chart looks like this, so this was the largest stock in the world at the time, Radio Corp of America. And we can see here it has 5 increments here, yeah? Or increments of $5 per share here. And it began somewhere here around 5. And then what do we know about what we have been talking about for a long time? The yield curve inverted in January 1928, right? Right here. Where was Radio Corp of America in January 1928? Well, if this is December 1927, this would be around January 1928, somewhere around here. And the stock ran from 20 up to 115, and then all the way back down to where it began, but even lower. Okay, so why was that? Because it doesn't matter if the year is 1929 or 2024. The people that were borrowing money to buy shares because they were greedy give it all back. Okay? So arguing that, oh, it's different this time valuations don't matter, everyone will just buy the ponzi forever. Okay, that's great. What about real estate? Look at this chart. Okay, this is inflation adjusted home prices. So this is a housing bubble. Okay, and then we're up here. Inflation adjusted home prices. This is currently sitting above 1. For it to fall down to where it has historically been on average, it should be around 50% lower in real terms. Okay. In regards to something for the stock market, again, we looked at this valuation table right here. But if you just look at this is inflation adjusted return. So this is, again, you can sit there and talk about money supply, inflation, all that shit, all you want. It's adjusted for that. GDP grows with the money supply and inflation. Look at the peak of the dot-com bubble. Look at 2007. Now, is this a timing indicator? Everything's bad tomorrow? No, but it's very expensive. Okay. What I don't get about people is that they're so hysterical to buy things. It's like if temporarily you go into a shop, right, and you want to buy a T-shirt, are you in a rush to buy things because it's going up temporarily? If you know it's temporary, how do we know it's temporary? Because nothing like this can sustain itself forever. It's impossible. So but in stocks it's different. Here people want to buy things as they go higher and higher and higher. Yes, I want to buy things when they're way higher. I really want to. Right? All right, yeah, you can speculate all you want. It wasn't a bad time to buy stocks in 2013, 2014, which is what the chart would suggest, right? This is the Warren Buffett indicator. Warren Buffett has been dumping over $100 billion of Apple shares. What does Warren Buffett say? He says you buy great companies and you hold them forever. You never sell. I made a tweet here about Bitcoin being a Ponzi scheme. This is not to hurt you guys, but the definition on all the sites that are good would say a Ponzi scheme is an investment scam that pays early investors with money taken from later investors to create an illusion of big profits. Okay. Why do you get? How do you get paid in Bitcoin or any cryptocurrency? Because of a greater fool. There needs to be someone, a bigger moron, that's willing to pay more for it. It's a textbook Ponzi scheme, and it creates an illusion of big profits. Earlier investors get paid with money taken from later investors, which creates an illusion of big profits. Textbook definition of a Ponzi scheme. Doesn't matter what you think. It's not an opinion. It's a definition. Do you remember in 2022 when the S&P 500 fell 27% and Bitcoin dropped 78%? Nobody lost their jobs and there was no recession. All right. Tell me what happens if the Nasdaq, which again, if we go back to the Buffett indicator, this is the Wilshire 5000. So this dropped about 50% here. But if the Nasdaq was to drop 80% like the dot-com bubble again, you think Bitcoin is going to run less? Well, it went down 78% in 2022. Now some people say, oh, every 4 years it's programmed to crash. Okay, let me just again open the chart. You can sit there and blame the crash on whatever you want. It doesn't really matter what your opinion is. It doesn't matter what my opinion is. But what we can look at is the fact that they top and bottom around the same time. Okay, so look at this right here. Also, again, I've shown this before. Look at the correlation. It's the same asset. Look, every little bounce here, all of that. Look at this price action. It's 95% correlated. And then they bottom at the same time and they top at the same time. They topped at the same time, they bottom at the same time. Bottom at the same time. It was affected in 2018 by this and Volmageddon in February of 2018. It's now going up and expanding with the Nasdaq. It is inversely correlated to gold, so it's not digital gold. How do we know that? Well, again, let me just bring up a chart of gold. Okay. When gold peaks here, yeah, right there, what happens to Bitcoin? Gold goes down. Bitcoin does what? Boom, up only. Okay. Gold breaks out here, right here, out of this range, okay, right here, and Bitcoin goes sideways, okay. When gold peaks right here, what happens to Bitcoin? Bitcoin breaks out. It's inversely correlated to that. You know what it is correlated to? The Nasdaq. Okay. So why is it not correlated individually every day here? Because the correlation comes from cross leverage. If people have position open in X asset, then if they get margin call and are liquidated in Y asset, then it affects the X asset in this case. Yeah. That's why there's a correlation. So I ask you again, if the S&P 500 went down 27% and Bitcoin went down 77%, nobody lost their jobs here, no recession. What happens to Bitcoin? Even if it goes higher, what happens to Bitcoin? If the stock market, if the S&P 500 goes down 60 to 80%, inflation adjusted, that's totally normal. This is the average mean. Okay, it was at 200 and let's see, let's zoom in. Okay, 206% market cap to GDP, which again is far higher than any of these previous crashes. Here the stock market crashed 90%, here the Nasdaq crashed 85%, here the indexes fell 60%. What's going to happen here? Well, it could go higher. The point being is, how does this end? Well, if the stock market goes down 60 to 80%, there's a very good likelihood that Bitcoin goes down 90 to 99%. What is the problem with that? Like I tweeted there. If the price drops too much and it doesn't recover, maybe you're not experienced, maybe you don't understand it, right? But if you've read the white paper, if you understand how Bitcoin actually works, mechanically, fundamentally, if all Bitcoin miners were to stop mining, transactions would no longer be processed and verified, and the network would effectively freeze, which would be the same as it being worth zero or being worthless, because you can never buy or sell them ever again. Okay? The network would freeze. So I present to you the biggest bear case for Bitcoin, which is that if it falls low enough and doesn't recover, it's a worthless asset. It doesn't do anything. It's a textbook Ponzi scheme. It's not my opinion. Okay. Now, what has MicroStrategy been doing? Well, if we go back and look, this is MicroStrategy in the dot-com bubble. It went up 4,400%. He was doing similar things. He was issuing shares to leverage and buy risk assets. Same thing right here. 99.9% down. Why would this be any different? He can never get out. And it will go to zero because of leverage. I mean, it went down 99.9% here. Why won't it now? Can it go higher? Sure. Okay, let's look at the clown bubble. Palantir. This is a very nice bubble right here. So the market cap for Palantir currently is 140 billion. It dropped a bit. It was 150 billion here. They have 290 million in earnings. So I have a friend from Denmark. He's invested in Palantir. He says it's going to the moon. Sure, but it's already on the moon. For this company to pay you back fundamentally, it would take them about 500 years. Palantir's price to sales ratio is 60. The average in the S&P 500 is 1.5. This is a joke. Denmark's GDP, which he's from Denmark, is 400 billion. And this company that gets 290 million in earnings a year is somehow supposed to be valued at 150 billion, more than one third of his country's GDP. Or how about Dogecoin? Dogecoin, look at this. Okay, Dogecoin market cap, it reached 65 billion here. You want to know what the problem is with that? Look at this. Sweden GDP. I don't know what. Okay, here. 590 billion. Okay? So you're telling me that dog coins created as a joke is worth more than what my country again, listen very carefully. Worth more than what my country produces in a month. I mean, this is next level retardation. Okay? Yeah, it's a nice speculative bubble. But so was Rate of Growth of America in the roaring 20s. And look, it went 6x during the yield curve inversion. The Dow Jones went from 190 to 380. Sure, the market can go higher. But look at the downside risk. There is so much risk here. Okay? Now I want to go over some other things. We're going to go over some macro related stuff here. Here is the non-farm payroll numbers. Are you going to look at the headline number and trust it? Look at the revisions. Down, 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 up, down, 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 down. We know that they faked 818,000 jobs, so looking at the headline number is completely pointless. August of this year, which came out at 142,000, August non-farm payroll number. Let's see. Jobs report August 2024. We're going to bring up the non-farm payrolls thing here as well on trading economics. We don't care about the actual number because the revisions, we know that they're faking the numbers, which geniuses are going to say, but they can fake the numbers forever. You haven't thought about the consequences, how that would backfire. Let me get into that first. What happens when the economic data seems stronger than expected? Interest rates rise. Long-term interest rates. Why? Growth and inflation expectations. Think about it logically. Why does long-term interest rates reflect growth and inflation expectations? If the economy is growing, if there's actual proper growth and you have inflation, then if you want to lend out your money for say 10, 20 or 30 years, then you want to be compensated for inflation risk and opportunity cost. If the economy is growing, well, you could be in other assets and get a better return. So you want to be compensated for the opportunity cost that you're taking on for parking your money with someone else lending it out to them, right? So we don't care about the actual number and non-farm payroll numbers. And again, the reason I brought up the interest rates is because if the economic data is, if they're rigging the data and it's stronger than expected, long-term interest rates rise. Okay, so if the data is actually fake, which we know it is clearly, it's not even a debate. It's a 30% miss. I showed you the numbers here. This is a complete joke. Okay. Same thing with the August number, which again, look at this. You see how it has 78,000 here? Oh, look, it says 142,000 here. So this 142,000 number when it came out, which everyone thought was amazing, right? It's now 78,000. Cut in half, pretty much. It's all a joke, okay? But it's about the trend. You see how I'm making these lower lows here? Okay. This is almost negative. If it wasn't for government, useless government jobs from government waste, then it would be negative. The private sector jobs growth is already negative. Where are the only times where this has happened in the past? Well, if I go to 2006, 2007, what do we notice here? It's negative in July 2007. But wait a second. At the time, was it negative? Here's a picture from 2007. So this right here would be July. You see how it ends on 07, 07. That's July. Minus 30,000. If this is 0, that's minus 30,000. If this is 250,000, let's say this was a 100,000 positive number, revised down to 30,000 minus. Okay. Once you go negative on the non-farm payroll numbers, what happens? I mean, you tell me. Let's go back and look at the dot-com bubble as well. Oh wait, that's the 1990 recession. Let's look at the dot-com bubble as well. What happened once you went negative? It wasn't so good, was it? All right, and where are we trending towards? Negative. Is it negative? Probably after revisions. You saw the trend on the revisions. It's a joke. So you can see the clown show here, as originally reported in orange. And we have the same thing in 2000. Look at these numbers. January 2001, what, 250,000 positive number gets revised down to like 20,000 negative. What a joke. This is a complete joke. This gets cut in half. Again, if you're looking at GDP, if you're looking at non-farm payroll numbers and you're actually believing it, maybe you should look at the history. 2001, 2% GDP, revised down to 1.3% of contraction. They can revise the shit for years later, or even a decade later. Okay? GDP in 2007, 0.6% growth, revised down to 0.2% of a contraction. Okay? So why should we believe these numbers? So I talk about the yield curve inversion a lot, right? Is there a correlation between the length of the inversion and the market drawdown? This goes hand in hand with valuations. Look at this. 100 to 200 day yield curve inversion length. And what is the difference between what does the length signify and what does the depth signify? The depth signifies how many people, like Warren Buffett, in his own words, have been inverting the yield curve. That's not a conspiracy theory. I'll literally bring it up to you right now. I brought this up in the video I made about Warren Buffett, but I'll do it again. In 2008, he said, "This is my personal account I'm talking about, in which I previously owned," listen very carefully, "I owned nothing but US government bonds." That means long-term bonds. When he buys it, the price goes up, the yield goes down. What does that do? It brings the long-term interest rate below the short-term interest rate. What does that do? Inverts the yield curve. So Warren Buffett did what? He contributed towards a yield curve inversion. Great. 100 to 200 days of a inversion. This is a drawdown in the stock market percentage-wise. 10 to 30%. When you go out to between 500 to 550 days, you have tended to see a 50 to 60% drawdown. In 1929, the inversion lasted for 700 days, from January 1928 until December 1929, and it led to a 90% drawdown. The one we just had that came out of inversion in September of this year was 794 days. So the depth signifies how many people like Warren Buffett are positioning themselves for a uncertainty or something bad that they think is coming in the future. They're always correct historically speaking. The length of the inversion signifies for how long banks have been fucked. Why? Because banks are affected by bank lending, right? In regards to if they lend money out, I mean, they borrow money short term and they lend it out long term. If it's inverted, the yield curve, taking a long term interest rate minus a short term interest rate, the banks cannot make money. Their business model is literally flawed. Okay? Again, September 18, 2007, they cut the interest rates down to 4.75. Here's the market reaction. Same thing this year. September 18th, 2024, by half a percentage point, down to 4.75. Okay, then people go, but what about the Fed? I get these questions a lot on my Twitter, and it's like they ask, I mean, I can just bring it up here. We have this guy asked me, what's your potential reasoning on Powell not wanting to cut rates? I'm like, the Fed does not control anything. Look, the 2-year yield in blue. The red line is the Fed funds rate. The blue line moves first, the Fed follows after. Let's quote Ben Bernanke, the Fed chair in 2008. When I was at the Federal Reserve, I occasionally observed that monetary policy is 98% talk and 92% action. The ability to shape market expectations of future policy through public statement is one of the most powerful tools that the Fed has. The downside for policymakers, of course, is the cost of sending the wrong message that can be high. Presumably, that's why my predecessor, Alan Greenspan, once told a Senate committee that he had learned to, let me bring it up. He had learned to mumble with great incoherence. They're not in control of anything. It doesn't matter what he says. So it's really funny, like, these people, they go like, oh, did you hear Powell, bro? He was so dovish, he was so hawkish, bro. So it's not just about the words that he says, which are clearly relevant, according to Ben Bernanke, which, again, he was the Fed chair. He was in the same position of power as Jerome Powell, saying that they don't matter. It's all just psychological manipulation, right? And people don't just care about what he says. They say, and again, they don't just care about the words that he says, but they care about how he says those words, right? Like, are you joking? They care about how he says the words. Okay, so now let's look at the stock market. The stock market is worth $60 trillion. How do we know? Current US GDP is 29 trillion. If market cap to GDP is 200% plus, it's 60 trillion. Okay. So people talk about, well, it's the Fed balance sheet that's been inflating the bubble. Really? Okay. So let's go back 10 years. November of 2014. Yeah, you with me? The Fed balance sheet was 4.5 trillion. Today it's 6.9 trillion. So it has gone up 2.5 trillion. So this has increased the money supply by approximately 10%. Actually, slightly less. Um, but what is this? Okay, so when they're expanding the balance sheet, they're only allowed to buy assets that are guaranteed by the U.S. taxpayer and the U.S. government. Okay, so treasuries and mortgage-backed securities. This has gone from 4.5 trillion up to 6.9 trillion. People go, they're printing so much money. They're not printing any money at all here since Q1 of 2022 at all. If you want to talk about this being money printing, okay. Now I beg to differ. This is not quite literally money printing. They're buying treasuries and mortgage-backed securities from the bank and non-bank entities. If you, as a person who has bonds, sell it in the open market and the Fed just so happens to be the buyer, you get money for it because they created bank reserves out of nowhere and they bought assets with it and they went onto their balance sheet. You get money for it, which increases them to money supply. Okay? Now they have literally reverse money printed $2 trillion from 8.9 trillion down to 6.9 trillion. So you're telling me since November of 2014, the past 10 years, a 2.5 trillion dollar increase on their balance sheet justifies a valuation increase in the stock market of about 212%. So a $2.5 trillion balance sheet expansion justifies the stock market going up about 42 trillion from 18 trillion to 60 trillion. The math is not mathing. I'm sorry, it doesn't. So I brought this up before. You could make the same thing today. You can make the same case today, September 26, 2024, if you were to put it like that instead. They're saying the same thing. U.S. inflation persisting in the economy should manage a soft landing. Dallas Fed. They're saying the same thing now. You remember in August we had a yen carry trade unwind? Well, guess what? That happened August 2007 as well. The recent volatility in global stock markets has raised the prospect of that a distinguishing feature of the financial world for years now, an investing tool known as the yen carry trade, may be coming to an end. Just like August of this year. Wow. Okay, now I want to show you this. So I went and I looked at FOMC minutes, economic projections by the Federal Reserve. And you can see here what it says. So here's the unemployment rate. Here's their projection, okay, for 2008 and 2009. Here's what actually happened, okay? You can see there, 2008, 4.8, 4.9, 2009, 4.8 to 4.9. In 2009, in 2008, in January, they raised their projection to 5.0 to 5.3. So they raised their projections here. They're saying the same thing now. It's not because they're stupid, they're very smart, but they're not allowed to tell you the truth. Why? Because then you go and behave in a way which makes it a self-fulfilling prophecy. So it's bad. Okay? Here's another picture I want to go over. What does this look like to you? Purple line going down, that's interest rates going down. Just like over here, just like over here, just like over here, and just like over here. So here we had a soft landing, but here we didn't, here we didn't, here we didn't, and here, what are we going to have? Well, let's look at the setup. Why was it a soft landing here in 1995? Because in red, again, when they were cutting interest rates in purple, the yield curve had never inverted. The unemployment rate was trending down, so it was a soft landing and the stock market did well. Here the yield curve had been inverted, they're cutting interest rates, unemployment rate is rising. Massive crash. Here the yield curve had been inverted, they're cutting interest rates, unemployment rate is trending up. So again, here they're cutting interest rates, and the unemployment rate is trending down, but here they're cutting interest rates and it's trending up. So here it was as a response to rising unemployment. Same thing right here. They're cutting interest rates, unemployment rate spikes. Here they're cutting interest rates. What is happening with the red line? The unemployment rate, it's going up. Here's the economy and the stock market. When the Titanic was sinking, half the Titanic was pointing towards the moon. That's asset prices. This is the economy. Why? Well, I showed you the non-farm payroll numbers trend. And also, I went over something with California's unemployment rate, which I think this is really disgusting how they do this. From last year, I have videos on this, okay? And Nevada's unemployment rate keeps going higher. Look at California's unemployment rate for last year. Why do you look at California? Because it's the largest state by population in the US. It was 4.7% in September 2023, right? We get annual revisions in December of every year. 4.7 September 2023. What is it today if you go to the chart? 5%. Go back and watch my video. The unemployment rate is about to go up in a vertical line in 2024. And what about this? It got revised higher. So we get revisions next month for the national unemployment rate. And you're going to see how it's going to continue going up and up and up and up and up. Okay? So all of this is a complete joke. It's a massive bubble. It doesn't mean you're like short the stock market because of that or something. That's not the point. Okay. Again, I think people get confused. Like they think, oh, you're so bearish. Oh, the market's going up. Listen, man. You should be bearish with valuations looking the way they do. I don't know where I have that even. Here. You should be. Now, that doesn't mean you should be out of the market if you're in the market because you can ride the trend. But you should know when to get out in that case. And I guarantee you, most people think they're gonna know when to get out, and they're not. What's gonna happen is it's gonna go down, and then they're gonna wait for a bounce, and the bounce will never give them enough of a satisfying exit. Okay, it'll hold all the way down. Expect a 60 to 80% downturn in the stock market based on these valuations and the current warning signs in the economy. So yes, everything is great right now, as the prices are pointing towards the moon. Dogecoin, $65 billion market cap, totally normal. Palantir, 150 billion, 290 million earnings. Dogecoins is worth more than what my country produces in a month. I just, but it doesn't mean I'm short the market. I've been bullish on XRP. I've been bullish on Theta. I've literally doubled that spot play money in the past week alone, right? So I'm not bearishly positioned in the sense that I'm not shorting the market. It has nothing to do with that. I think people get confused. When I talk about macro, it's unrelated to my trading. I showed them my equity curve. It's up only up and to the right. Okay, and it will remain that way even when the market turns. And another analogy for this, again, which I brought up before, is it's just like when you wake up in the middle of the night, you need to piss. You ignore it over and over and over again until eventually you have to go and face the problem and need to go piss. The same thing here. You can ignore it while you're at this part of the Titanic, right? As the prices are there. But once it starts to sink, I mean, it's just going to go underwater. What are you going to do? This happens every time. So there are a few quotes from the roaring 20s, which led to the Great Depression, which is like unemployment had been rising for months, and the speculators didn't care until eventually the bubble popped, and then everything got really bad. So enjoy the bubble while it lasts, but know when to get out, and this will not end well. If you think the current market valuations are justified, I showed you the math with, again, they have not printed a single dollar in 37 months. The money supply is at the same level as it literally was in October of 2021, 37 months ago. You can see it. So no, this is not justified by money supply expansion. Nothing. They're doing reverse money printing. So yeah, enjoy. Peace. Take care.